and welcome to everyone. Thank you for joining today. Maybe I can give a quick introduction and then introduce our panelists today and maybe dive in from there. So my name is Sal Ternullo. I'm the co-lead of Cryptoassets at KPMG in the US and also play a role across our global member firms supporting and scaling what we do in the crypto space. I've had the pleasure and fortune of working and collaborating closely with Adrien Treccani, who is the CEO and founder of METACO, one of the leading institutional custody and tokenization solutions in the market, gaining significant traction across both Europe, Asia Pac, and now North America and the US as well. And similarly, I'm joined by Rebecca Aspler, who is the Director of Product Management at Unbound Tech, who I have similarly had the fortune of collaborating with over the past 18 months on everything from product innovation to next generation security models, looking at multi-party computation. So Adrien, maybe it's helpful if you start this morning and just expand on an introduction and tell us a little bit more about METACO and the work that you've been doing with Silo, and then we can pass off to Rebecca and do the same quickly as before we jump into our kind of core themes of discussion today.
Thank you, Sal, and it's a great pleasure to be here today with you and Rebecca to discuss this topic. So a few words about METACO. METACO is a company that is specialized in digital assets management solutions. So what does it mean? So it means that if you're a bank and you want to offer Bitcoin or Ethereum services, or you would like to tokenize something and make it live on the blockchain, well, you need infrastructure for this. Infrastructure that will take care of every security aspect of it, where do you put the keys, how do you set up the governance around these keys, how do you connect this to your core banking, how do you make sure everything is compliant. And the Silo solution provided by METACO is precisely this. It is all about offering this complete package, allowing the bank to become digital asset compatible and therefore connect to these new technologies.
Super helpful. Thank you, Adrien. And Rebecca, maybe if you can take a moment and do the same and just contextualize what Unbound Tech is doing.
Sorry, I was on mute. So nice to be here. Thank you everyone for taking the time to join this session today. My name is Rebecca Aspler. I'm Director of Product Management at Unbound Tech. Unbound Tech is specializing in multi-party computation. Not necessarily, I would say, for blockchain. We're actually experts in enterprise security, and blockchain is one of the product lines that we're dealing with, simply because with blockchain, the key is the asset, therefore the most vulnerable type of asset you need to protect. Unbound has been very much privileged to be working with both METACO and KPMG to be able to bring to the market enterprise-grade type of I would say security platforms, but not just security, but platforms. Our specialty is, of course, security, but we're part of the, I would say, pioneering community, bringing, I would say, blockchain to the mass adoption phase. So that's us.
That's awesome. And Rebecca, you were quite effective at queuing up kind of where I'd love to start the conversation today in this idea of mass adoption. And a word that has been, frequently circulated in the industry around institutionalization. And I think, over the past 6 months, especially following regulatory guidelines and clarity, both in the US and abroad, we've seen a significant uptick in banking institutions and nationally chartered banks, state chartered banks that are pursuing, at a pace that they have not in the past, adoption of crypto and digital assets, raising the issues that Adrien brought to the fore around digital asset management, and obviously begging the question around security as well. So in the context of institutionalization, maybe if Adrien, starting with you, can you share a brief perspective in terms of how the tone of the conversation has shifted from maybe the beginning of 2020 pre-pandemic to the end of 2020 where we stand today, and now December, crazy enough, December 1st here?
Absolutely. Maybe before starting about 2020, just a little bit catch up about the previous years, where cryptocurrencies have been widely adopted in terms of in terms of speculation capability by the retail. Many investors like myself came in this market many years ago. But if you think about it, banks have been largely skeptical about cryptocurrencies and Bitcoin. However, they have been highly enthusiastic about blockchain technology and in particular permission ledgers, so more private versions of what we see today with Ethereum or Bitcoin. Surprisingly, tokenization, or expectedly, some would say, tokenization has been something, and blockchain technology have been much slower for adoption than originally projected. And what we see today is that what was originally the main goal of banks, which was to create tokenization use cases for equities, for fixed income securities, derivatives, or non-bankable assets, has shifted back in 2020 to payment tokens, in particular with cryptocurrencies, but also with stable coins like potential Libra or central banks getting more vocal about such tokens. So I would say the big difference in 2020 is with the obviously drama of this COVID crisis, and with stable coins being backed by major institutions on the market, we see a very strong push towards adoption now of open cryptocurrencies and stable coins. And I would say that this is something we can now feel as a very concrete trend in banking.
Yes. If I could echo that and maybe add a point of view of what we see in the banks. So being an enterprise security type of company, we're in banks anyways. They're encrypting data with us. They're doing VHSMs with Unbound. And it's very interesting to see the journey that they are taking. So 3 years ago, they deployed and were very, I would say, courageous and early adopters in, for example, adopting even VHSM. And they were implementing private blockchain infrastructures, or I would say discussing the required infrastructure for cryptocurrencies or stable coins or whatever asset class it would be. In the last half year, we see more and more banks actually closing deals and actually bringing those, I would say, from the innovation labs into the production stage. And therefore, companies such as Unbound and METACO are pretty much, I would say, very fortunate to be in the market right now with production-based systems. But for us, it's very interesting to see the journey that banks are taking. It's pretty much like they've been waiting, the building infrastructure for clearing and settlement type of use cases, doing, kind of substitutes for SWIFT type of transfers. And as soon as the regulator added a bit of clarity, as soon as you see PayPal going in, they're pretty much like, I would say, clicking the trigger, if that would be the right term, and ready to conquer the market.
That's interesting. Maybe just picking up and rounding out that conversation, because it relates very well to an experience that I've had in my career, starting at State Street and really spending the better part of 2015, 16, 17, building on top of very early incarnations of Hyperledger Fabric .7, .8, looking at things like Chain.com in 2015 and really early incarnations of enterprise Ethereum. And so after spending a number of years working and building on actually some solutions that were aligned to the use cases Rebecca mentioned, I recognized in my own view that the kind of Web3 era of token-based payment systems, mechanisms of store value, value exchange would be the future. And so that's actually why I landed at KPMG in 2018 when I came here. Was we have a keen focus on crypto and digital assets and have segregated that focus from our enterprise blockchain business, which has allowed us to be really, really close to our clients in the market, understanding the crypto specific nuances as it relates to cybersecurity risk, as it relates to AML compliance, or consumer protection, which are all core issues that regulators across the world focus on, regardless of the principles or rule-based systems that they actually implement. So Rebecca, maybe picking up on something you mentioned around kind of the dynamic of movement. You mentioned PayPal moving into the space. I think we've had a precipitous change in kind of the dynamic around the space, maybe triggered by the PayPal move, maybe not. But following that discussion, we've seen a pivot in the point of view of a number of different banks. So we've seen public research notes now, proclaiming and drawing comparisons between gold and Bitcoin in ways that is kind of antithetical to what we might have seen even just a year ago today. So maybe starting with you, Rebecca, knowing that you're very close to kind of that institutional security pain, as that shift from innovation lab to production has taken place, can you talk a bit about kind of the pain points that you see along that journey, and how you and Unbound are helping to bring these solutions from the innovation lab into a production environment.
This is really interesting. It might be interesting for me as a technology geek, but I really feel that the journey is both technological, but not just technological, I would say more psychological than the technology one. The technology is there, is proven. I would say that just, utilizing Bitcoin as an example, but not just Bitcoin, cryptocurrencies are simply new asset classes. They're not different in the sense of, investing in a stock market for that matter. It's not more dangerous than that. But it seems as if people are keen on seeing what the institutions would do and only then coming in to the market. So in that sense, it's not different than any other type of revolution that we've seen in the market. So it could be the BI, the business intelligence revolution, evolution now. We think about it even 30 years ago, or the social revolution. I still remember people talking about Facebook as the thing that is about to, get gone. And look at us now buying stuff through Facebook, Instagram, etc. My kids don't even have Facebook. It's considered old for that matter, and they're just 17. So in that sense, cryptocurrencies are pretty much, led by the youngsters, by the early adopters that might be called the wild, wild west kind of investors. But since PayPal, I was just, following up on that. Since PayPal made its announcement, the Bitcoin jumped pretty much from 12K to now 18K. So you can't really underestimate the influence that these institutions have on the adoption of these simply new asset classes by us, by the regular investors, the family owners, the family offices, the, I would say, very high rank type of investor in the bank, or even an insurance company that has to decide upon an investment portfolio. So 2 years ago, they would have said, okay, I'm looking at it. Now they're gonna add 5% of their portfolio to be invested in Bitcoin, and someone has to protect that. Now, Unbound and METACO are both experts in protecting that. We'll probably, discuss that later on. But part of their concern is their image, their willingness to go into this simply new market, unknown. And then once you dive into the details, the way that you protect those assets, and they're pretty much scared because so many things have happened, hacks of various types. But we'll probably dive into that later. Security is no longer an issue as long as you do it right, like any other type of asset. I would like to hear Adrien's point of view, if that's okay.
Absolutely. So I would say, the main frictions that we've seen for adoption of something, I agree with you, is simply a new asset class with kind of different security foundations or technological foundations, but with the appropriate infrastructure behaves exactly the same as the traditional assets in terms of how you can interact with it. I would say the main frictions were threefold. On one side, infrastructure; second, regulatory environments; and third, the demand itself. So demand, infrastructure, and regulations. What we see is that in the last 2 years, demand is coming back, and all of these announcements about large investors, about large corporates investing in cryptocurrencies are bringing a lot of new investors themselves that are making this demand go higher and higher. And we now get feedback from private banks that there is another session of FOMO where their clients are looking to invest because they see the price rising, and it creates this unhealthy, I would argue, behavior of the price where the price goes up because everybody is afraid to miss out on this opportunity. But still, demand is here now, and it's very strong. Second thing is regulations. And Sal, you introduced this topic already. Things are moving. We see in Switzerland, Germany, Singapore, more recently in the US, and many other countries are opening up. This is no longer a friction. It used to be 5 years ago, a Bitcoin had this reputation of being the money of criminals, something being used in the dark web to buy drugs and hitmen. Well, I mean, today, if you look really at numbers, what is used for buying drugs and hitmen is certainly dollar, Swiss franc, and euro. Bitcoin is a tiny game, a tiny player in this game. And many studies show how irrelevant the criminal activity is with cryptocurrencies, at least these main cryptocurrencies. I think more than ever, beyond this, there are today many tools that allow to have some forensics on transactions and know where the funds are coming from, know where you're sending bitcoins, and have a high level guarantee, a strong guarantee that you're not interacting with tainted coins. And so as a bank, not only do you have the regulatory framework on your side, but you can now have all of the internal processes assuring that you have the appropriate controls and compliance. Third point is obviously the infrastructure, and here I second what you said, Rebecca. I think it is no longer a question of how to do it. There are very strong solutions on the market, and I think obviously that Unbound and METACO's solution is very, very strong and proven solution on the market. So we're not the only ones on the market, but it's no longer a question of how to do it. There are very good practices, there are best practices. This concern can be kind of delegated to companies like we are, so that in the end, interacting with Bitcoin, Ether, or tokens feels very much the same for the bank as interacting with a different asset class.
Yeah. I would like to, sorry, if I may, is it okay? Just to, I would say, even give credit to additional partners of us, I would say 3 companies. So as an example, CipherTrace, I don't know if people are aware of this name. They're experts in AML, and all the customers that we're working with are either implementing CipherTrace or another company, let's say Chain Analysis. And this is very important because unlike US dollars, with AML companies today, you can actually trace exactly where the money came from and the number of steps it went through. So banks can actually have an AML grade to be able to decide if they're sending money out, yes or no, to a certain address. And if the risk grade, just as an example, is 8+, just as an example, the risk policies of the bank itself, they could decline a transaction using METACO's or Unbound tool or the joint, I would say, solution of both companies. But I think that one of the themes I was am hoping for people to take out of this session is exactly what Adrien said. It's no longer a question of how you protect it, you can protect it. It's no longer a question of fraud or AML. You have better tools because of the concern in the market to protect your withdrawals, to protect your investment compared to the US dollars. It is just, you know, taking the time to learn what you can do. That's it today, 2020.
No, I think I would echo that point, Rebecca and Adrien as well. I mean, the question, the dynamic over the past 2 years since kind of the first 2017 asset valuation increase was, you know, what happened was massive capital formation around these critical issues supporting adoption, being data, AML, and custody. And over that time, the investment cycles over the past 2.5, 3 years have led to significant maturation and alignment of product market fit as well. And I think this conversation and collaboration between Unbound and METACO is an exact example of that. And bringing a next generation security technology to enhance and optimize a digital asset management solution end to end. And meeting that idea of it's not a question of can banks do this safely, it's how do you do it safely, and bringing the right experts into the room to help build an effectively controlled business and technology environment. So maybe if it works for you, Rebecca and Adrien, pivoting slightly into kind of the second theme of our conversation and maybe just tying it back to the first theme as I set the stage. So obviously COVID has introduced a number of changes into everyone's lives. One of the most significant changes has been kind of the change to the monetary policy landscape and how that has played out in terms of economic stimulus, whether to individual participants or to entities within different jurisdictional economies. And I think, you know, that heightened need for effective stimulus distribution raised a lot of questions, and those questions were being raised in parallel to significant progress with major private sector projects like Libra, as well as the rise in adoption of stablecoins in breaking through earlier in 2020, the $10 billion plane, and now being north of 30 billion across different stablecoins. So this drive of kind of private and public sector innovation sets the stage for the dialogue of 2020 around central bank digital currency. which is obviously an area that we're keenly focused on and collaborating with our clients, but also something that I know METACO has spent a lot of time focusing on as well. So maybe, Adrien, if you could start with this one and kind of take a viewpoint and maybe digest on, your view and METACO's view of the state of CBDC in 2020, end of 2020, and maybe a viewpoint in terms of kind of the different actors that we're seeing across the space and the types of actions that they're taking.
Absolutely. So METACO has been involved in this field for almost 4 years now. Not that this field has been extremely active in 2016, but we were already doing R&D and in contact with several central banks in, what could be done at this stage, which was mainly brainstorm, early POCs or reflections. The truth is, even last year in 2019, even though we were building, we knew that this would take years and years before we would go in production with any product whatsoever. We had discussions with half a dozen central banks with ongoing projects. As you may see also, as part of the shareholders of METACO, we have two of the largest central bank suppliers, in particular for cash and banknotes. And so we've worked with them on such topics and tried to open this market. But until last year, had you asked me this question, I would have told you that nothing would have happened until 2025, nothing concrete. However, this year has been so special, with, as you say, Libra becoming something concrete, or at least opening a new trend of stablecoins, and the COVID's pushing us even more towards digitalization. And, I'm just going to give you a blunt statistics here, but I have a few numbers which I think are very explicit. First of all, today, 80% of every central bank is doing research, active research on CBDC. So this number may not be the most interesting because active research can mean anything from looking at the impact on unemployment, on inflation, or writing some academic papers, which in the end has nothing concrete at the end. But as part of this 80%, half of those, so 40% of central banks, are doing concrete POCs. So they're really working on something concrete with some form of product which they can experiment with, and therefore he's hoping to get at some point in production. Out of all central banks, 10% actually have a concrete project aiming production. And this is something very new. This is something new that it's no longer about doing economic research. It's really about finding the right solution and moving forward. And not moving forward until 2025, potentially having something productive in the next 2 or 3 years. I would say this is maybe the biggest technological question. Today, we're speaking a lot about Ethereum, about Libra and other stablecoin or distributed ledgers on the markets. My point of view here is that it may be that CBDC is actually not running on such platforms, at least to start with. If you think about it, a CBDC, as its name indicates, is a central bank coin. And the central bank has a very important word, which is central. It doesn't necessarily need to be decentralized, I mean, otherwise we can call it the decentralized coin, decentralized CBDC, or I don't know what it would be, but DDDC or something like this. So it is centralized. What it means is that in the end, the central bank may want to open digital tokens to anybody to facilitate access to the economy for unbanked citizens or individuals, but it may not need to have the consensus around this coin being spread amongst miners or stakers or any of these permissionless consensus protocols. Therefore, what we see today is more a question about, what is this infrastructure going to look like? Who is going to be maintaining it? Is it going to be the payment processors that work with the central bank, or is it going to be the central bank itself or its banking partners? But most probably it will start being relatively centralized initially. However, my bet, and here I have no numbers to confirm that and no clear information, my bet is that today the central bank thinks it in two ways. It's either fiat with cash, something physical you can touch, or it's something through the banking system. And this is a digital version of central banks, central bank money. In the future, I would not be surprised that there is some kind of abstraction around which ledger is used. And it may start with a highly centralized ledger controlled by the central bank. And if Ethereum gains so much traction that it becomes unavoidable, then the central bank may say, well, I'm going to actually issue some coins on Ethereum in addition to my own platform, which is maintained by myself as a central bank. I wouldn't be surprised that in the end, the role of the central bank is to be the issuer and the trusted party backing the coin, and not so much about having a dogmatic view of the technology backing the coin itself.
It's super interesting. And I think, Adrien, the thesis that you just presented over kind of the control model shifting towards decentralization in the future is something we believe as well. I think that thesis is similar to what your CBDC perspective in 2016 was now for me, and thinking 2030 is the dynamic where we see permissionless blockchains underpinning central bank digital currency. But if you look at the nature of hires being made by the US Federal Reserve, they're hiring Bitcoin core engineers at scale. That sends a strong signal in terms of protocol level design and how they're thinking about the future, which is probably more on the research than on the development side today, but does kind of provide a leading indicator to the trend that you're talking about there. Rebecca, I know this is all near and dear to a number of discussions that you have. Any points to expand in terms of the dynamics that Adrien highlighted around kind of the 2016 to 2020 state of CBDC?
Just echoing your words and Adrien's words, I wouldn't repeat them, just echoing them. That's pretty much in research labs, pretty much like Bitcoin was in 2016 in the banks. People are talking about it. People are examining various, I would say, research projects. They're mostly talking about that. Right now, the fact that they're willing to adopt Bitcoin as a new asset class of investment, or Ethereum, or the various, I would say, ERC20 token type of investments as part of a portfolio investment. This is what I would say is on the mind of the bankers today, both the business owners and also the technology owners. So that's pretty much shifting. Bitcoin is getting into production, CBDC is getting into the research labs. So we'll probably see them in 4 years, 5 years, pretty much like you've said, going into production. I really liked what Adrien said about decentralized versus decentralized. This is something I cannot figure out yet. How is it going to work? If the central term is part of the word itself. And I agree as well with Adrien and with you, Sal, it's probably going to be the infrastructure and the ledger behind the scene, but not so much the management of the assets themselves. So it's going to be really interesting, but still a journey to just begin.
Agree.
Maybe, can I just say a couple of words on top of this? Maybe this also clarifies why CBDC is so different to traditional cryptocurrencies. The objectives or the requirements of a CBDC are very much different. If you think about it, what you want with central bank money is to be able to transact offline, for instance, or to have some high degree of privacy. I'm not saying perfect privacy, but at least better than what you can get with cryptocurrencies. You also want to have extreme scalability. It is crucial that you can reach dozens of thousands of transactions per second, and probably more than that. That you have also finality in the transaction, that it cannot be, your blockchain cannot be forked, and the last 6 hours of transactions are just canceled because miners thought otherwise. So these requirements make it very difficult at this stage of technology to imagine that such a coin will be deployed on the Ethereum chain, for instance. If you think about it, Ethereum doesn't have finality of the transactions, at least for now, doesn't have enough scalability to support thousands of transactions per second for now. The privacy is very limited, as which is, from a compliance point of view, is a good point. As Rebecca mentioned earlier, it gives you so much traceability that as a bank, you have a very high degree of confidence that the coins that you're accepting are not tainted. But as a user, if you want to replace physical cash with digital cash, well, you better hope that your digital cash is not so transparent that either the government or your neighbors can follow what you're doing. And so this is, all of these criterions, and also the fact that today transacting offline with cryptocurrencies, although you could find ways of doing so, it's certainly not designed for that. Whereas, you would expect that even if you're out of internet connection, you could still transact with, with your CBDC coin. So all of these requirements make it very hard to think that the first iteration of such an initiative would run on Ethereum or an equivalent platform. But my earlier point is that I think it will not just be a single platform. I think ultimately the central bank will have potentially multiple targets and will support the ones that satisfy the requirement that it has.
Fully agree. And I think that point you just made around ledger systems was reinforced with the release of Project Aspler from the Saudi Arabian Monetary Authority alongside the United Arab Emirates, in one of the most, I would say, clear and effective papers written across ledger systems and product capabilities, privacy technology implementations, and also very, very strong outlook in terms of adoption in those regions. So, maybe wrapping the CBDC question on a question not about CBDC, but on the interaction between CBDC and stablecoins. So we've been focused a lot in thinking about how might the fabric of the monetary system evolve through this kind of rampant adoption of stablecoins. And even just yesterday, Christine Lagarde put out a perspective thinking about the potential that stablecoins have for risks in relation to financial stability. And it's a conversation I'll be picking up with her in less than 4 hours from now as part of the Atlantic Council's Geoeconomic Center, focused on the rise of central bank digital currency, which is launching actually today at 12 Eastern. And she'll be giving the keynote there talking about this. So interested to get your thoughts in terms of the interaction model between CBDCs and stablecoins, and whether or not you see kind of perceived risks around the dynamics of financial stability as a result. And maybe starting with Rebecca on this one and then pivoting to Adrien if that works.
So my input would actually be echoing the former, I would say, thoughts. Since we see the CBDC pretty much at the laboratory level, at the innovation centers today, then I would say, correlation or joint thoughts about stablecoins and CBDCs are pretty much like, I would say, even philosophical at the moment, which is, of course, amazing. And I am very much keen. I wish I was a fly in the room, Sal, of your next discussions. These are, I would say, are other things that shape our future, but are they related to the current, I would say, state of banks or enterprises? I'm very much sorry to say not yet. They're pretty much at the state of even willing to adopt Bitcoin. They're so, and I'm very much respectful of that. They're very cautious. They're very careful. They're moving slow. We're just reaching the mass adoption stage. So stable coins are pretty much, if I'm not mistaken, catching only even less 6% of the market as far as a total volume. So Bitcoin and Ethereum, as much as I'm repeating those, are and their various forks are catching about 80% of the market. So these are things that I'm very much keen on being part of discussion-wise, because this is the future. Unfortunately, this is not yet still the reality itself.
I think that makes a lot of sense. So maybe in that context, Rebecca, Adrien, rather than driving into that kind of policy discussion, there is a commonality across all virtual or digital assets, and that commonality is custody, and the idea that any bearer asset or any asset whose control is functioning as a result of a key pair relationship, right? And so there is some commonality in the concept of custody. And I believe personally that a lot of the regulatory moves in Switzerland, Germany, and the United States clarifying positions of nationally chartered savings banks and financial institutions is done intentionally in a way that paves the path forward for activation of custody capabilities across the banking sector, not only to support Bitcoin, as was projected by the Office of Comptroller of Currency in the US, but also to support collateral for stablecoins and likely in the future interaction with a central bank digital currency. So maybe that's the crossover point, Adrien, for you to pick up if you'd like, is to talk a little bit about how METACO is kind of tackling the custody challenge and the central bank digital currency space, understanding that we're still pretty far from public blockchains being the ledger system.
Absolutely. I mean, what is a digital asset custody solution after all? It's generally three modules which can be many more than that, but at the least you need these three things. One is a key management component. You need to be able to put these keys somewhere. Reason being that working with digital assets, the whole security paradigm relies on notion of asymmetric cryptography, where this key is the ultimate password to unlock the funds. So you need a key management solution. Second of all, you need some form of governance layer. How do you access these keys? Under what conditions are you going to authorize a transaction or an operation on the chain? And all of these things in the end are even more critical, I would argue, than just the key, because if compromised, however security you've put around your keys, you just can access the box and ask the box to sign anything. And this anything could be empty in your wallet. The third point is what we like to call the accounting layer. So how do you interface yourself with the ledgers? What is your balance? What is your transaction history? And something that banks know very well how to do, but which is particularly complex with cryptocurrencies because of these forks, the chain reorganizations, the lack of finality of a transaction. In the context of CBDC, I would argue that the main pillar at this stage, the main pillars are the first two, which are how do you manage the keys, and not just to store the assets, but also to mint and burn. Because of course, as a central bank, you want to do more than just storing. You probably are not even a custodian. You may delegate this custody responsibility to your banking partners. So your main responsibility as a central bank is how do you inject new liquidity on the market? And to do that, well, generally you would go in your printing press, press the green button or Control P on your keyboard, and you would start printing billions and billions of dollars or something else. But with digital money, if you secure this digital money with a private key, well, this Control P on your keyboard is no longer really relevant. Somebody that can steal your private key potentially could print zillions of dollars, of fake dollars, and they will look exactly the same as real ones. So managing the key is critical, but you also want to manage who can access these keys. So the second pillar about governance, about the entitlements. And I would say this is really where we see the most important point at this stage, allowing the central bank to create infrastructure, not really about where the accounting will be maintained. So not really the ledger itself, is it going to be Ethereum? Is it going to be a permission or a private ledger? But mostly about the infrastructure to interact with any given ledger with the appropriate controls and key management that the central bank is confident this is at the least as secure as its current physical printing press.
That's a perfect pivot. Oh, you're on mute, Rebecca, but I was going to say this is a perfect pivot point between governance, policies, and security into kind of our final theme of the day, and a perfect triage to Rebecca, who is in my mind probably on the fore of security expertise, not only in key management broadly, but absolutely within the multi-party computation space. So Rebecca, maybe if starting with you and kind of expanding on that policy piece, maybe talking a little bit about the work that Unbound and METACO are doing together in bringing dynamic MPC-based policy management into a full-scale digital asset management solution, and how the security models of Unbound are playing out in that integration plan.
Yes, thank you for that. This is probably the second theme of I would say, the messaging that I'm hoping that the audience would take out from here today. Being a multi-party computation company, we're experts in generating a key that actually does not exist as a key because it's multi-party computed. So what we do with these parts that are never reconstructed, because it's not Shamir secret sharing, that's often, I would say, a misconception of multi-party computation. We can have actually various types of models. And this is important when we're starting to discuss the custody models, because you can either save or protect a full key, mostly done, I would say, with HSM system, but you can actually protect the same key in its sharded manner. And this is one of the things that we're doing with METACO. So METACO is a great partner and is offering a security platform that is one of the best in the market, if not the best one, as long as it's not, multi-party of Unbound for that matter. So working with METACO and Unbound preferably together, you can actually have the best, I would say, security platform out there, having a VHSM behind the scenes. So you're getting the protection of the key, the governance of the key, the interfacing with other systems, and at the end of the day, the key never exists, which is counterintuitive. So that's one way. And I would say that another way to think of protection of keys when it comes to blockchain is pretty much like we discussed, we started the discussion saying if banks are getting into the picture, they need governance systems or approval policies that are very much in line with what they're already doing. And I'm very much appreciative of the cautiousness that banks are taking, or even enterprises, regardless of banks. Every transaction, regardless of the fact that it's a blockchain asset class or a fiat asset class, requires the signing of several people, mostly more than two. I mean, each of us ever, when we signed a transaction, we sign it and then it goes into the bank and another clerk is signing it, and probably a branch officer, a supervisor, an AML officer. So you get at least 5 to 6 people, even 10, depending on the amount that are signing the same transaction. So with multi-party computation, if you can imagine a situation where you have n number of key shards, and each of the signers, or more precisely, each of the approvers holding just one key shard that is continuously being randomized and refreshed, you can actually empower banks to keep on the regular workflow, approval workflows, but just now using multi-party computation. And this goes back to the fact that Adrien and I and you, Sal, are saying it is no longer a question of can you protect the keys? It is a question of, are you knowledgeable about the ways that you can protect the keys with, whether these are HSMs, whether these are VHSMs, whether these are multi-party computation type of systems. So the tools are there, the policies are there, just learn and decide what's better for you. As simple as that.
I agree. I think that the dynamic that you just described, meeting the governance conditions, the integration patterns with core banking applications, and doing this while abstracting the complexities of digital assets away from the user or banking institution, but allowing them to have the same level of control and rigor around enterprise financial services controls, both for the business and for the technology stack, that align to their information security policy and existing parameters around how they manage risk. So I think, Adrien, as we're kind of talking about the security model, I think it's an interesting viewpoint. The market was super excited to hear about the integration between Unbound and METACO. In thinking through kind of the 3 pillars of custody as you described, can you mention a bit about how the Unbound integration and the work that you're doing together is changing the dynamic of those pillars, if at all?
Absolutely. As a matter of context, if you think about how Bitcoin has worked historically, Bitcoin natively provides already quite a few features on-chain to implement workflows. By default, you would rely on these simple addresses, as they're called, where you have the key on your mobile phone and you can unlock your Bitcoins by signing with your mobile phone. But of course, as you can imagine, your phone becomes critical. As soon as you're the only signer and your phone is compromised, potentially all of your wallet is emptied in a single transaction. So Bitcoin allows what is called multi-signature. So you can have on the chain, validated by the blockchain itself, a wallet that requires multiple mobile phones to jointly approve by signing with their own respective private keys for the transaction to be processed. And originally, that was the approach that was taken by the most paranoid, in a good sense, crypto exchanges on the markets that wanted to decentralize the trust and make sure that there was no single point of failure in their custody infrastructure. Now, the difficulty with this approach, or the weakness, I would argue, is that, well, there are multiple ones, but one of them is that it is highly protocol specific. So if you want to have a particular governance scheme on Bitcoin, let's say an N by N multi-signature scheme, and then you want to implement the same thing on Ethereum, potentially it's a completely different implementation. On Ethereum, you would need a smart contract, for instance, to do that. And there even exist cryptocurrencies that do not support a multi-signature at all. If I push this further, I would argue that most banks, and Rebecca made this point, they need more than multi-signature. They need more than just N by N. They may need multiple different parties depending on the amount. It could be that if the amount is large, they need compliance to be more involved, a manual verification, etc. Those are things that, although you could have them in smart contract on Ethereum, that would not work on a chain like Bitcoin. And most probably, even on Ethereum, you don't want to have everything publicly auditable by any observer just looking at what's happening on the chain. So the second approach is to say, well, let's not put that in the chain. Let's try to put that off chain and have my governance framework, my controls, all set up off the chain. But then when you have this, you start asking yourself, okay, but how do I make sure that this governance framework is unbreakable? And that what used to be unbreakable on the chain, because it's verified by all of the miners and all the nodes, if I remove it from the chain, I want to make sure that it is still impossible to break, and I will be able to enforce these rules very strictly. And so one of the answers to this is you can use special purpose hardware that is called hardware security modules. So hardware which has been designed to have a very small attack surface, to be highly trusted, it is certified, it's generally with special chips that control all of the processes, and it works well. It's been used actually for many, many years in the banking industry for various use cases and applications. However, it has also some downsides. It's difficult to program. It is less agile. It also means that you need to deal with the hardware. So if you're an on-prem kind of bank, it means that you need to buy hardware and maintain it, which can be okay, and many banks do that, but also can be relatively painful at an era where you prefer working with the cloud or with virtual machines. And so MPC, or multi-party computation, is kind of a third approach where you say, I still want my scheme to be, my governance framework, my rules to be validated on-chain, but I want the chain to only see a sort of result which proves that I've had all of the parties required that came before, but I don't want to show to the blockchain all of this, who these parties were and what the scheme was precisely. I want these parties to validate off the chain and have a mathematical guarantee that the result they generate can be verified by the chain and will formally demonstrate that all of these parties approve the operation. So the security model is kind of different in the sense that rather than relying on trusted hardware, you split the key, or you have multiple fragments of the keys in different locations, and jointly multiple parties can approve and sign a transaction, which ultimately will generate a single signature that can be verified by the chain, but which before that ex ante requires multiple joint approvals to be gathered. And so at METACO, we were historically heavily relying on hardware. This was the default model that we had for the security of keys and governance. However, we see METACO as being a company which should not have to impose a model to our clients. We see very strong advantages for MPC. We also see advantages for hardware in specific applications. And we think that METACO should not have a dogmatic opinion over what is the best approach. Even today, there are use cases for hot wallets, there are use cases for cold wallets, air gapping, etc. And all of these different kind of use cases, they may require very broad, very different solutions. And so the partnership with Unbound is so important in the sense that it gives METACO the opportunity to today tell its clients, you don't have to choose, or you can choose actually, but you don't have to choose today. You can, if you have, for instance, I don't know, the IT department or information security department saying they don't want to work with MPC for some reason today, well, you can migrate to MPC even if you start with hardware. Or the other way around, if you think that MPC is perfectly fine, but you may want a cold storage later down the route, you can do it. You have the same product and the same solution, the same APIs, and you support both models. So this partnership with Unbound makes it very, very strong offering where actually the bank doesn't have to take a strong decision today. And we think that the best of both worlds, which is having both solutions, is now possible for the banks onboarding digital assets.
That's awesome, and I can just speak. I know we're coming up to the Q&A session here, but I can speak from anecdotal experience over the past 18 months in helping to bring together both METACO and Unbound in initial conversations. In a recognition of the change of product market fit requirements, or frankly, not a change, but a better definition on the client side of what do we actually want, and then a recognition from all of us in the market that what banks want varies significantly by the model of how conservative they are, what their risk tolerance is as an organization, what their regulatory constructs look like. And so to Adrien's point, there is no one defined model for custody, hot, cold, warm, whatever it might be, that meets every use case. It's about having a dynamic and agile capability that can be configured and deployed across asset types and use cases with the appropriate security model for the use case. And I see, Rebecca, you're coming off mute, so I'm sure you have a piece to add on there as well before we shift into Q&A.
Yeah, just sharing our journey, my journey. When I joined Unbound 3 years ago, we were pretty much, and it was all over the website, it's no longer anymore there. We pretty much said we're the pure software solution out there. And we were very much sure of the fact that we don't need hardware, you know, anywhere around the system or the solution architecture. We have FIPS level 2, we're very proud of, etc. But that's pretty much like Adrien said, we can no longer justify, you know, a pure software approach. It's pretty much the maturation of the market and the various use cases. And we're very much respectful of what customers want. And it's our duty as an enterprise security type of company to be as open as possible, as agile as possible. And I would say even contribute to the maturation of this community, bringing together a software-based solution that is secure as hardware. We're still standing, you know, behind this statement, but joining hands with companies out there, creating a very, I would say, reliant type of solution that could be hardware-based, could be trusted execution based in the sense of not HSM, but, you know, SGX as an example, run MPC within SGX, help our customers comply with FIPS level 3 and 4, and therefore must be having HSMs around there somewhere. There's no other way to have FIPS level 4 if you're not having HSMs behind the scenes. And working with METACO has been very meaningful for us, you know, going together to these enterprise-grade customers. And pretty much, and it was not the case 2 years ago, we were pretty much competitors and we still are in certain markets. But the fact that we're doing this event today together, I think is a good testimonial of the fact that we've come to understand that joining hands and I would say acknowledging the benefits of each solution is better for the evolvement of the market itself. So, you know, it will come back to us in one way or another. So that's really great, the way that we're moving on.
Fully agree. And I think, Rebecca, it's been a pleasure collaborating with you directly, and the same, Adrien, over the past 18 months. I think the future is very bright. We're on the edge of 20K in Bitcoin price, and the altcoin rally is continuing. So I think everyone's got some excitement as we head into the end of December, although we've got potentially more travel restrictions coming. So maybe starting quickly with Q&A, I know we had one question come in via the chat, looking for a quick list of 3 to 5 bullet points for startups or businesses as they prepare for this era. And maybe I can start very quickly and just summarize 3 domains that we talked about today. First, starting with data, the idea of everything crypto or digital assets on the data side, getting intelligent about networks, markets, how traditional, incarnations of reference rates and indexes are calculated in the crypto market and how those things are different, really getting grounded in the information. The second step forward generally is around custody, and in complement with custody is AML. So if you start with those 3 bullet points of data to get intelligent and to inform your strategy and decision making, custody and AML is kind of the first step to facilitate a regulated business. And then there's obviously a slew of tangential adjacent domains that are process and control related that are super important. But if you're thinking to try to distill this down into 3 bullet points, I'd start with data, custody, and AML. So I'm sure there's some other questions from the audience. If so, please feel free to ping the chat. Jan, I'm not sure if you've received any additional questions as we've been chatting here this morning, but we can hang on and give everyone another minute if there are additional questions. All right, and if there's no further questions, obviously I think we'll make ourselves accessible via email. If you're interested, feel free to follow up on LinkedIn as well. And really a huge thanks to the Disrupt Network for structuring and running a fantastic webinar. I know it's difficult in these times managing multiple time zones. And personally, a huge thanks to you, Adrien, and to you, Rebecca, as well, for sharing your insights this morning and giving a perspective of kind of cutting through the hype and giving us some pragmatic reality of what's actually happening in the market, which I always appreciate. So thank you.
Thank you very much, Sal, and thank you, Jan, for the organization.
Thanks.